Singapore bank stocks have been on the tear recently. Over the past 1 year, all three Singapore banks, DBS, OCBC and UOB, have gone up from anywhere between 30% to 45%. And this is excluding dividends. If we include the 5 to 6% dividend use, this return could even reach 53%. This is hardly the kind of returns that you would expect from boring blue chip bank stocks. In fact, this outperformance was so strong that it has finally allowed Straits Times Index to break past its 18 years of sideways performance and reach a record high. But then, how long can the banks continue to outperform? And is this now still a good time to buy Singapore banks? Let's find out in this video. In DBS' latest financial report, their quarterly profit rose by another 10%, thus allowing it to achieve yet another record performance in 2024. However, even though DBS' initial strong financial performance was driven by the high interest rate environment, in recent quarters, net interest income growth had already started to slow down. For those who are unfamiliar, net interest income is the difference that the bank earns by taking our deposits and paying us an interest versus lending the money out to borrowers. For example, back in 2022, DBS net interest income rose by a whopping 40% as compared to the previous year. But now, this has slowed down to just 5%. This is hardly surprising given that interest rates have already peaked back in 2024 and have already started to come down. Instead, what's driving the strong performance for DBS now is its strong growth from fee income. If we look at the fee income breakdown, we can see that the biggest growth came from wealth management. This was due to more and more family offices setting up bases in Singapore. Likewise, wealth management have also seen a strong rise in both UOB and OCBC. Q comments saying that more and more rich people coming into Singapore and driving up property prices, which isn't true, yeah, just in case you are wondering. Not just that, given that the markets have been doing rather well recently and there's a rise in volatility, this led to a growth in both treasury customer sales as well as market trading income for DBS. In fact, DBS performance was so good that they are now sitting on $6 billion worth of excess capital, of which $2 billion will be used to redeem its additional T1 capital securities and the rest to be used to reward its employees and shareholders, such as giving a $1,000 bonus to all staff each, except for senior managers. Poor senior managers. Introducing a new capital return dividend of 15 cents per share, which will bring the total quarterly dividend from 60 cents up to 75 cents in 2025, as well as introducing a $3 billion share buyback program over the next few years. Basically, DBS is now hwatting like xiao lah, and they are now trying to manage down the stock of excess capital over the coming few years. Likewise, both OCBC and UOB are also hwatting like xiao, though not as much as DBS. And they are also planning to reward shareholders, while also using the money to further grow their business. Quick pause. If you are looking for the cheapest broker to start your investing journey, check out Interactive Brokers. It has the lowest fees for stocks, ETFs, options and more. Not just that, Interactive Brokers lets you easily research stocks. Like, you want to check out companies' financials? Here it is. You want to check out analyst ratings? Here's a bunch of them. It even has free technical insights which tells you where the stock might possibly go next. So sign up to Interactive Brokers today. And let's get back to the video. So, how long can Singapore banks continue to hwat big? Right now, I think the biggest headwind facing banks is the upcoming rate cuts. Currently, the market is projecting that rates will go from the 425 to 450 basis points range, down to the 350 to 375 range over the next 1 to 2 years. Admittedly, this is at a much slower rate than was originally planned, because many of Trump's policies are inflationary, such as his tariff plans, immigration policies, as well as tax cuts. Because of that, the Fed wants to take things a little slower now. However, in the worst case, or rather best case scenario, the inflation might even hit up to the point that the Fed is forced to start raising rates all over again, something which is good for the banks and jialat for the REITs. But for now, barring any unforeseen circumstances, interest rates are expected to come down in the future, which will eventually impact bank profits. Thankfully, the good news is that banks have started to diversify their revenue source, and as a result, becoming less and less reliant on net interest income. For example, DBS now estimates that the net interest margin sensitivity has reduced to just $4 million per basis point, as compared to the previous $80 million during 2021. This represents a drop of almost 77% in NIM sensitivity over the past 3 years. Likewise, NIM sensitivity has also decreased by 40% for both OCBC and UOB as compared to the previous cycle. Because of that, analysts expect that each 25 BPS Fed rate cut to only reduce Singapore Bank's 2025 earnings by just a tiny 1 to 2%. Not just that, given that the US economy is able to achieve a soft landing, aka no recession, as well as optimism in China's macroeconomic policies, the modest rate cut will actually spur loan growth, which will help to offset any decline in net interest income in 2025. Pair that with a strong rise in wealth management, both DBS and UOB are expecting high single growth for non-interest income as well as double-digit growth in fee income in 2025. Basically, banks expect to continue to whack big this year lah, even when there's a rate cut coming soon. Besides that, another big headwind that is facing Singapore banks right now is the high valuation. Right now, DBS has a historical high price-to-book ratio of around 1.9x. This is way higher than its historical average of 1.19 times PB ratio. Likewise, both OCBC and UOB PB ratio are equally high. This shows that all three banks are expensive when you compare them against their historical average. However, here's where you need to be careful. As the saying goes, markets can remain irrational longer than you can remain solvent. Just because something is overvalued doesn't mean that it will automatically boom and crash tomorrow. It can continue to remain overvalued as long as the banks can continue to deliver strong performance. In fact, even though DBS is already at record highs, analysts are still expecting it to go up by another 10 to 11%. And while there's currently not much upside left for OCBC and UOB, it's very likely that analysts will also revise their price targets upwards after their earnings results. Which brings us to the question, is it now too late to buy Singapore banks? Personally, I think that there's still some more potential upside, as rates are expected to remain higher for longer, and there are multiple tailwinds for the bank, such as rise in wealth management income and probably also Trump deregulation policies. However, I also think that the risk-reward ratio has already become a little more unfavorable, as there is now a limited upside while the downside risk has become a lot more. That's because in order for the stock to continue doing well, all it needs to do is to continue its current growth trajectory. In fact, the banks have said that there is higher earnings visibility into 2025 as net interest income sensitivity has decreased, there's stronger loan growth and benign asset quality. So as long as this fantastic growth can continue, the banks will have no problem doing well. But on the other hand, there are a number of things that can cause the share price to go back down. For example, DBS expects their 2025 profit to drop due to the 15% global minimum tax implementation in Singapore. Though, this by itself won't crash the stock price, as Gupta-san has pointed out that even though NIM will go down, this loss can be recovered from the trading market side as well as wealth management and treasury customer sales. However, if ever there's an unexpected event, like a recession for example, the Fed may be forced to do a huge rate cut. This could cause the net interest income to shrink by quite a bit, and because there's a recession, the number of bad debts could go up and the number of loans could go down. Or even if there's no rate cut, but the Singapore economy starts to shrink, we will also see loan growth slow down and bad debts going up. Or maybe the market starts doing badly and the banks start seeing losses on their market's trading income. This can also affect their profits as well. As to when that will happen is anyone's guess. The banks could continue going up or maintain their share price for many months or years to come. But one single bad event and we can see their share price correcting downwards. With that being said, I do think that there are still many other investments that you can look at besides banks. And probably one of the most obvious examples is REITs. So while banks are currently richly overvalued, REITs on the other hand are now rather undervalued, as their current price-to-book ratio is already near its historical lows. This represents a good buying opportunity if you are interested in REITs. Though, just be aware that given that the rates will stay higher for a while longer, REITs may continue to do badly during this period. But I guess in return, you'll get to enjoy some rather attractive dividend yields in the meantime. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.